In 2008, Wall Street banks collapsed because they made fraudulent loans they knew would fail, packaged those loans as safe investments, sold them to your pension funds and retirement accounts, and when it all exploded, they received $16 trillion in secret loans from the Federal Reserve, while you got nothing, not $16 billion, $16 trillion, which is more than the entire federal budget, more than the cost of every war America has ever fought. And you never heard about this, because it was kept secret for years until a Government Accountability Office audit in 2011 finally revealed the truth. And during this same crisis, 13 million Americans lost their homes to foreclosure, $50 trillion in household wealth was destroyed, and not a single Wall Street executive went to prison. And by the end of this video, you'll understand exactly how much Wall Street stole, who got the money, why they faced zero consequences, and how they're setting up the exact same scheme right now with commercial real estate, which means you'll get robbed again, unless you understand how this works and why the system protects bankers while destroying you. The background to the 2008 financial crisis reveals that it wasn't a natural disaster or a surprising market event, but rather a deliberate fraud scheme that Wall Street executed, knowing it would eventually collapse. In the early 2000s, investment banks realized they could make enormous profits by originating mortgages, packaging them into securities, and selling them to investors. And the more mortgages they originated, the more money they made. So they started making loans to anyone, regardless of ability to repay. These were called subprime mortgages, loans to people with bad credit or no income verification or no down payment. And the banks didn't care if these people could actually pay, because the banks weren't holding the loans. They were immediately selling them to investors packaged as mortgage-backed securities. Here's how the scheme worked. A person with terrible credit and no job would go to a mortgage broker and say, "I want to buy a $500,000 house." And the broker would say, "No problem. We'll give you a no-doc loan, meaning no income documentation required, and we'll give you an adjustable rate mortgage that starts at 3% interest but adjusts to 8% after 2 years, and we'll give you a negative amortization loan where your payment doesn't even cover the interest, so your balance actually grows every month." And the person would sign because they believed housing prices always go up, so they could just refinance or sell before the rate adjusted, and the broker would get paid a commission, and the loan would be sold to an investment bank like Goldman Sachs or Morgan Stanley or Lehman Brothers. Then the investment banks would take thousands of these garbage mortgages and package them into a mortgage-backed security, which is a bond that pays investors based on the mortgage payments coming in, and the banks would divide these securities into tranches, with the 88 tranche supposedly being the safest because it got paid first, and the BBB and lower tranches being riskier because they got paid last. But here's the fraud. The banks knew these mortgages were garbage. They had internal emails calling them toxic waste and crap, but they went to the rating agencies, Moody's and Standard & Poor's and Fitch, and paid them to rate the securities, and the rating agencies gave 8AA ratings to securities that were backed by subprime mortgages to people with no jobs. And why did the rating agencies lie? Because the banks paid them, and if a rating agency refused to give a good rating, the bank would just go to a different agency. So the agencies competed to give the best ratings to the worst securities, and this meant that pension funds and insurance companies and retirement accounts that were required by law to only buy A-rated securities were buying garbage loans to unemployed people, believing they were as safe as treasury bonds. And Wall Street knew this was fraud, but they made billions in fees, so they kept doing it. But here's where the scheme became even more criminal. Wall Street didn't just sell these fraudulent securities, they bet against them. They created credit default swaps, which are essentially insurance contracts that pay out if the mortgage-backed securities default, and banks like Goldman Sachs would sell mortgage-backed securities to clients while simultaneously buying credit. Default swaps betting those same securities would fail, and this is the equivalent of a used car dealer selling you a car they know has a faulty engine while taking out an insurance policy that pays them. When your engine explodes, it's fraud, and Goldman Sachs made billions doing this. They sold garbage securities to investors. Those securities failed, Goldman collected on the credit default swaps, and the investors lost everything. Meanwhile, John Paulson, who ran a hedge fund, figured out the scheme and made $15 billion personally by betting against the housing market using credit default swaps. And Michael Burry, who was portrayed in The Big Short, also made hundreds of millions betting against mortgages. And they weren't criminals. They just recognized the fraud that Wall Street was committing and bet it would collapse. But the difference is they weren't the ones selling the fraudulent securities. They were just betting against them, whereas Goldman Sachs and the other banks were selling securities they knew were worthless while betting they would fail, which is textbook fraud. What would you do if you discovered that the banks that manage your retirement savings were deliberately selling you investments they knew would fail while betting against those same investments? And when everything collapsed, they got trillions in bailouts, while your retirement account lost half its value and you got nothing. This is exactly what happened in 2008, and most people still don't understand the scale of the theft because the media focused on the $700 billion TARP bailout, which was visible and voted on by Congress. But the real theft was the $16 trillion in secret loans. If you're starting to understand that the 2008 financial crisis wasn't about complicated financial instruments or systemic risk, but was actually a deliberate fraud scheme where Wall Street knowingly sold garbage investments while betting against them and then got bailed out with your money when it collapsed, stay with me, because what comes next will show you the exact numbers of who got how much, why nobody went to prison, and how they're doing the exact same thing right now with commercial real estate. Subscribe now, because very few channels will show you the documented evidence of the $16 trillion theft and explain why the people who committed the fraud not only faced zero consequences, but are richer today than they were before the crisis. The $16 trillion figure comes from a Government Accountability Office audit that was mandated by the Dodd-Frank Act and released in July 2011. And this audit revealed that between December 2007 and July 2010, the Federal Reserve made $16.1 trillion in emergency loans to banks and corporations, and this wasn't publicly known at the time. The Fed kept it secret, and when Bloomberg News sued under the Freedom of Information Act to get the details, the Fed fought the lawsuit all the way to the Supreme Court to try to keep the information hidden, and they only released it after Congress forced them to through the Dodd-Frank audit provision. Here are the specific numbers of who got how much. Citigroup received $2.5 trillion in loans. Morgan Stanley received $2.04 trillion. Merrill Lynch received $1.95 trillion. Bank of America received $1.34 trillion. Barclays received $868 billion. Bear Stearns received $853 billion. Goldman Sachs received $814 billion. Royal Bank of Scotland received $541 billion. JP Morgan received $391 billion. Deutsche Bank received $354 billion. UBS received $287 billion. Credit Suisse received $262 billion. And the list goes on, and these weren't just American banks. Foreign banks received trillions, and these weren't just banks. Corporations like General Electric received $16 billion. Harley-Davidson received $2 billion. Even McDonald's received $200 million, and all of this was secret. None of these companies disclosed to shareholders or the public that they had received emergency loans, and the loans were at interest rates far below market rates, often less than 1%, which meant the Fed was essentially giving free money to banks that had committed fraud. Compare this to what homeowners received during the crisis, and you'll see the complete inequality of the bailout. 13 million American families lost their homes to foreclosure between 2006 and 2014, and the government programs designed to help homeowners were deliberately ineffective. The Home Affordable Modification Program was supposed to help 4 million homeowners, but ended up helping fewer than 1 million, and the help was minimal, maybe reducing monthly payments by a few $100s, while the banks that caused the crisis received trillions. If you lost your home in 2008, you got nothing. The bank foreclosed, you were evicted, your credit was destroyed, and you had to start over. But if you were a Wall Street executive whose fraud caused the crisis, you got a trillion-dollar bailout. You kept your job, you kept your bonus, and within a few years your bank was more profitable than ever. JP Morgan CEO Jamie Dimon had a net worth of $200 million in 2008. Today he's worth $2 billion. Goldman Sachs CEO Lloyd Blankfein was worth $400 million in 2008. Today he's worth $1.5 billion. Bank of America CEO Brian Moynihan was wealthy before the crisis and is now worth $200 million. And none of them faced any consequences. No criminal charges, no jail time, not even a reduction in compensation. Instead, they got richer, while 13 million families lost their homes. Here's exactly why no Wall Street executives went to prison, even though they committed obvious fraud. and this reveals how the justice system protects the wealthy while prosecuting everyone else. The Department of Justice under Attorney General Eric Holder explicitly decided not to prosecute Wall Street executives, and Holder later admitted in congressional testimony that the banks were too big to jail, meaning prosecuting executives might cause the banks to fail, which would harm the economy. So instead of prosecuting fraud, they let it go unpunished, and this created a precedent that if you commit fraud on a large enough scale, you're immune from prosecution because you're too important to the system. The few cases that were brought were settled with fines that were tiny compared to the profits. Goldman Sachs paid $5 billion to settle claims related to mortgage-backed securities, but they made over $30 billion in profit during the crisis years, so the fine was just a cost of doing business. JP Morgan paid $13 billion, Bank of America paid $16.65 billion, but these fines were paid by the banks, meaning shareholders, not by the executives who committed the fraud, and the fines were tax-deductible, which means taxpayers subsidize the penalties for fraud, and no individual executive faced criminal liability. They settled the cases, paid fines with other people's money, and kept their personal wealth and freedom. The contrast with how the justice system treats ordinary Americans is staggering and proves we have two systems of justice. In the same years that Wall Street was committing trillion-dollar fraud and receiving trillions in bailouts, over 2 million Americans were in prison, many for non-violent drug offenses, and the average sentence for bank robbery is about 5 years, and the average amount stolen in a bank robbery is about $4,000. So if you walk into a bank with a note demanding $4,000, you get 5 years in federal prison. But if you're a Wall Street executive who defrauds investors out of billions of dollars through fraudulent mortgage-backed securities, you get 0 years and you keep your billions. And this isn't hyperbole, this is documented fact. Not a single major Wall Street executive went to prison for the fraud that caused the 2008 crisis. The only person who went to prison was a mid-level Credit Suisse banker named Karim Serageldin, who got 30 months for hiding losses, and he was prosecuted because he was foreign and expendable. But the American executives who ran the entire fraud scheme, who knew they were selling toxic assets, who bet against their own clients, who lied to investors, who paid rating agencies for fraudulent ratings, they're all free, they're all rich, and many are still running the same banks. Now let me show you the specific evidence that proves Wall Street knew the mortgages were garbage and sold them anyway, because this is what makes it fraud rather than just bad business judgment. Internal emails from Goldman Sachs referred to mortgage-backed securities as shitty deals and crap, and executives talked about selling these securities to widows and orphans knowing they would lose money, and Goldman was simultaneously buying credit default swaps to profit when these securities failed, so they knew the securities were bad. They sold them anyway, and they bet against them. That's fraud. At Citigroup, executives celebrated selling CDO squared products, which were securities backed by other securities backed by subprime mortgages, creating triple leverage on garbage loans, and internal documents show Citi knew these products were toxic, but sold them because the fees were enormous. At Washington Mutual, which was the largest bank, failure in American history, loan officers were pressured to approve every loan application regardless of ability to repay, and they referred to certain loans as ninja loans, no income, no job, no assets. But they made these loans anyway because they could sell them to Wall Street. And then Washington Mutual failed, and JP Morgan bought it for pennies on the dollar with government assistance, and the WAMU executives faced zero consequences. The rating agencies were complicit in the fraud, and their role was essential to making the scheme work, because pension funds and insurance companies couldn't buy non-investment grade securities, so Wall Street needed A ratings. Internal emails from Moody's referred to the rating process as building a house of cards and selling it before it collapses, and rating agency employees admitted they were under pressure to give good ratings or lose business, and the agencies operated on a business model where the banks issuing the securities paid for the ratings, which is an obvious conflict of interest. The seller of the product is paying for the seal of approval, and when subprime mortgages started failing in 2007, Moody's downgraded 83% of mortgage securities rated AA in 2006 down to junk status within 18 months, proving the original AAA ratings were fraudulent, but the rating agencies faced almost no consequences. They paid small fines and continued operating with the same business model, and today the same three agencies that fraudulently rated mortgage-backed securities still rate 95% of the bond market using the same conflict of interest business model. Here's what defenders of Wall Street claim about the bailouts and why their arguments are completely dishonest. They claim the bailouts were loans, not gifts, and the government made a profit. This is technically true for the TARP program where most banks repaid the money, but it's false for the 16 trillion in Fed loans which were given at below-market interest rates, meaning the true cost was the difference between what the banks paid and what they should have paid at market rates, and the government gave up trillions in potential profit by loaning at artificially low rates, plus the opportunity cost of what that 16 trillion could have done if invested in infrastructure or education or given to homeowners rather than banks. They claim the bailouts saved the economy from total collapse, but this is unfalsifiable because we can't know what would have happened, and it ignores that letting fraudulent banks fail and prosecuting executives would have sent a message that fraud has consequences which might have prevented future crises. Instead, we sent the message that fraud is profitable and will be bailed out, which is why banks are bigger and more dangerous today than they were in 2008. They claim the crisis was caused by government policy encouraging home ownership through Fannie Mae and Freddie Mac, but this is a distraction. Yes, government policy encouraged home ownership, but it didn't force banks to commit fraud. Banks chose to make fraudulent loans because they could sell them and make fees, and Fannie and Freddie bought some of the securities, but private Wall Street investors bought most of them, and the fraud happened at banks, not at government agencies. The practical consequences of the bailouts extended far beyond just transferring 16 trillion to Wall Street. It fundamentally changed the structure of the banking system and made future crises more likely. Before 2008, the largest banks held about 20% of banking assets. Today, they hold over 50%, because during the crisis the government forced smaller failing banks to merge with larger banks. So Bank of America bought Merrill Lynch and Countrywide, Wells Fargo bought Wachovia, JP Morgan bought Bear Stearns and Washington Mutual, and these mergers were encouraged by regulators who wanted to avoid bank failures. But the result is that banks are now much larger and much more powerful and much more too big to fail than they were before the crisis, which means the next crisis will require even larger bailouts. Meanwhile, the people who lost their homes have not recovered. Home ownership rates fell from 69% in 2004 to 63% in 2015 and have only partially recovered, and an entire generation of young people watched their parents lose their homes and decided renting is safer. And wealth inequality exploded because households lost 50 trillion in wealth, while Wall Street recovered all their losses within 3 years and went on to record profits. Here's the evidence that Wall Street is setting up the exact same fraud scheme right now with commercial real estate, and this time it might be even bigger. Since COVID, office buildings are 40 to 60% empty because remote work became permanent, and these buildings are financed with commercial mortgages that are coming due in the next few years, and the buildings are worth 30 to 50% less than the mortgage values because nobody wants office space anymore. And the banks that made these loans are pretending the loans are still worth full value on their balance sheets, even though the underlying buildings are worth half. And this is the same scheme as 2008, banks making loans they know will fail, hiding the losses and waiting for a bailout when it collapses. Regional banks are especially vulnerable. Many community banks have commercial real estate loans equal to 300 or 400% of their capital, meaning if those loans default, the banks are insolvent, and the Federal Reserve is already preparing for this. They've created new emergency lending facilities similar to the ones they used in 2008, which means they're planning to bail out banks again, and once again the executives will be protected. The shareholders might lose some money, but the executives will keep their jobs and their bonuses. And if you have deposits in these banks and the bank fails, the FDIC only insures $250,000. Anything above that you might lose, unless the government declares your bank systemically important and bails it out, but they won't know which banks to bail out until the crisis hits, so you're gambling that your bank will be considered important enough to save. The final lesson from the 2008 bailouts is that the system is designed to protect Wall Street at all costs, even when they commit fraud, and this is permanent unless there's a political revolution that changes the incentives. Wall Street controls both political parties through campaign contributions and lobbying. In the 2008 election cycle, Wall Street donated over $400 million to candidates, and in every election since they've donated similar amounts, and this money buys protection, it ensures that regulations are weak, that enforcement is minimal, that bailouts are guaranteed, and that executives never face criminal liability. The revolving door between Wall Street and government ensures regulatory capture. Eric Holder, who decided not to prosecute Wall Street, returned to a corporate law firm representing banks after leaving the Justice Department. Treasury Secretary Tim Geithner, who oversaw the bailouts, went to work at Warburg Pincus, a private equity firm, and dozens of other officials who made decisions favoring Wall Street during the crisis have gone on to lucrative jobs at banks and investment firms. And this pattern continues. Former Fed officials join banks they used to regulate. Former bank executives become Fed officials and Treasury secretaries, and the result is a system where the people making rules about banks are either former bankers or future bankers, so the rules always favor banks. Now you understand how Wall Street stole $16 trillion in 2008. They made fraudulent loans they knew would fail. They packaged them as safe securities and sold them to your pension funds. They bet against their own clients using credit default swaps. They paid rating agencies to lie about the quality of the securities, and when it all collapsed, they received $16 trillion in secret loans from the Federal Reserve, while 13 million Americans lost their homes and got nothing. And you understand that not a single Wall Street executive went to prison because the Department of Justice declared them too big to jail, and the executives who committed the fraud are now richer than they were before the crisis. And you understand that the same fraud is happening right now with commercial real estate. And when that collapses, Wall Street will get bailed out again while you'll be left with the bill. And the only way this changes is if enough people understand the theft and demand prosecution of executives, breakup of too-big-to-fail banks, and an end to the revolving door between Wall Street and government. But this won't happen because Wall Street controls both parties through campaign contributions. So the theft will continue, the bailouts will get larger, and your wealth will be transferred to Wall Street every time they create a crisis, which they do deliberately because crises are profitable when you know you'll be bailed out. If this revelation about how Wall Street stole $16 trillion while you lost your home and got nothing has made you understand that the system is rigged and the 2008 crisis wasn't a natural disaster, but a deliberate fraud scheme that was bailed out instead of prosecuted, if you're finally seeing that the same executives who committed fraud are still running banks and are setting up the same scheme with commercial real estate, if you're angry that 13 million families lost their homes while Jamie Dimon and Lloyd Blankfein became billionaires, then you need to see what we reveal next, because the bailouts are just one part of a larger pattern of wealth transfer from you to Wall Street. Subscribe now and prepare to discover how the Federal Reserve created $9 trillion during COVID and gave it to Wall Street while you got a $1,200 check, how private equity is buying up single-family homes using cheap Fed money and turning America into a renter nation, how derivatives have created a $600 trillion bubble that will require bailouts that make 2008 look small, and how every financial crisis follows the same pattern. Wall Street commits fraud, profits massively, collapses, gets bailed out, and is larger and richer after the crisis than before, because once you understand this pattern, you'll see why wealth inequality keeps accelerating, why you'll never own a home, why your retirement account loses value while Wall Street profits, and why this will never change unless the people get angry enough to demand prosecution of bankers, breakup of too-big-to-fail banks, and an end to Federal Reserve bailouts of fraud. But that won't happen because most people don't understand that Wall Street stole $16 trillion, and the media won't tell you, and the politicians won't stop it because Wall Street owns them, so the theft continues, and the next bailout is already being prepared, and you'll be left with the bill again.